Welcome to vTalkInsight, Market Drivers Daily for June 10th, 2026. AI-driven tech volatility, Middle East tensions, and a pivotal U.S. inflation print are pulling on risk assets in different directions today. Let's start with how the AI trade is evolving. The AI theme remains the primary driver of global risk assets, but the character of the trade is changing. After months of near one-way gains, rising volatility and pockets of drawdown suggest the AI rally is moving into a more late-stage, selective phase rather than a broad beta trade. Market volatility has picked up as nerves build around the AI-led tech rally, with U.S. tech indices under pressure ahead of key inflation data and renewed Middle East tensions. Commentary now openly questions whether parts of the AI complex resemble a late-stage bubble, as stretched valuations collide with higher rate expectations and a heavier calendar of capital raising. One large AI server manufacturer has announced a $7 billion equity raise to fund roughly $39 billion of orders, and its shares have sold off sharply on dilution and execution concerns. At the same time, a handful of mega-cap tech firms are expected to issue more than $600 billion of debt this year to finance AI and chip expansion, underlining just how capital-intensive this cycle has become. The earnings picture is increasingly concentrated, with roughly half of S&P 500 earnings growth tied to companies exposed to AI infrastructure, while private equity deal activity in technology and software stays subdued as buyers wait for clearer proof of durable AI revenues. Within public markets, investors appear more willing to fund scaled platforms and infrastructure providers, while being more skeptical of highly dilutive raises or business models dependent on ever-cheaper compute. Against the bubble narrative, there is still strong evidence of real demand. TSMC has reported around 30% year-on-year monthly sales growth driven by AI chips. Cloud providers are seeing cloud infrastructure revenues rise at very rapid rates, and a $4 trillion-plus AI infrastructure investment wave is cited as being underway. AI deployment is also delivering tangible productivity gains, from significant cuts in general and administrative costs after acquisitions to revenue acceleration at data and software layers as enterprise adoption broadens. Looking ahead, attention is turning to the coming AI IPO pipeline, including high-profile names such as SpaceX and Anthropic, and how markets absorb large equity financing for both infrastructure and model providers. Policymakers are also debating whether to take direct stakes in leading AI firms or impose tighter controls, which could reshape competitive dynamics over time. All of this intersects with energy demand and Middle East risk. So let us turn to the geopolitical backdrop. Geopolitics in the Middle East remain a key macro swing factor, even as headline market reactions look relatively muted. Recent Iranian attacks on U.S. bases in Bahrain, Kuwait, and Jordan, followed by U.S. retaliatory strikes and signals of further potential action, have kept geopolitical risk elevated and injected bouts of risk-off sentiment into global assets. Both sides have shown periods of restraint, with truce negotiations described as intense and mediated by Pakistan and regional actors, including discussions of a lengthy moratorium on uranium enrichment. Yet the status of the Strait of Hormuz remains central. Some crude shipments have resumed, including several million barrels from Kuwait to Asia and over 100 million barrels transiting recently. But flows are still below pre-conflict levels, and markets increasingly recognize the risk that closure could persist. Brent crude has been oscillating around the low $90 area, briefly rebounding above $90 after fresh U.S. strikes, but failing to sustain a sharp breakout, suggesting a degree of headline fatigue. Analysts note that recent oil spikes have not yet been large or long-lasting enough to create significant pass-through into U.S. core inflation, even though negative supply shocks and higher gasoline prices are a key driver of the latest inflation prints. Beneath the surface, energy and logistics stress is accumulating. Global oil and gas inventories are being drawn down to offset lost supply. Freight costs are rising as ships reroute around conflict zones, and Asian coal demand is surging as countries restock ahead of a forecast-strong El Niño in 2026. This combination raises the risk of future energy shortages and structurally higher transportation costs if alternative sources and routes fail to fully compensate. For regional economies, the stakes are high. Iranian attacks on Qatar's energy infrastructure are estimated to have caused around $20 billion in lost revenue, potentially constraining its sovereign wealth fund, while ambitions across Gulf states to become global investment and data center hubs are being undermined by uncertainty over long-term security guarantees. Putting it together, markets appear to be pricing a persistent risk premium in energy and freight rather than an immediate supply shock, but the tail risk of a renewed spike in oil and gas prices remains significant if diplomacy falters. That risk feeds directly into the inflation and rate debate, which is already being reshaped by today's U.S. data. So we now turn to the monetary policy picture. The monetary policy narrative has tilted further toward higher for longer, with inflation data now forcing markets to reassess the path ahead. Headline U.S. consumer prices are running around 4.2% year-on-year, the highest in 3 years, driven largely by higher gasoline and energy costs linked to Middle East disruptions and strong demand from themes such as AI infrastructure. After a strong U.S. jobs report and a run of upside inflation surprises, traders are increasingly treating the Federal Reserve's next moves as binary. Either policy stays on hold, or the central bank is eventually pushed into multiple rate hikes if data keeps surprising on the upside. Some scenarios in the rates market now envisage 3 additional hikes starting in December and no material chance of rate cuts before 2027 if inflation proves sticky. Bond traders have increased duration shorts, with expectations that the 10-year Treasury yield could end the year near 4.5%, and the U.S. dollar has firmed on the prospect of further Fed tightening. The traditional 60-40 portfolio is offering less diversification, as equities and bonds have at times sold off together around inflation and geopolitical shocks, while gold and silver prices have come under pressure from higher real yields. In credit and private markets, the higher rate environment is steadily biting. There's a large backlog of pre-2022 deals struck at low yields and high valuations that now face significant repricing, with private equity exits difficult, real estate transaction volumes muted, and signs of growing credit stress in more leveraged corporate and property sectors. Set against the hawkish narrative, several counterarguments are gaining weight. Inflation expectations remain broadly anchored. Parts of the recent inflation spike are seen as energy-driven and subject to base effects. Initial jobless claims are edging higher, and hiring plans are historically low, all of which support the idea of a gradual soft landing and give the Fed some cover to keep rates steady while focusing more on balance sheet reduction. Outside the U.S., the picture is uneven. Euro area growth is stagnating near zero, raising concerns that further European central bank hikes could damage demand, while elevated saving rates in the UK suggest additional Bank of England tightening may not be necessary. For risk assets, and particularly AI-related equities, this higher for longer but data-dependent backdrop means funding costs and valuation multiples are likely to remain under scrutiny, and the interaction between any renewed oil shock and the front end of the yield curve will be a key focus for the coming weeks. Across today's themes, a few threads stand out. The AI trade is moving from a broad momentum story to a more volatile, capital-intensive cycle with pronounced winners and losers, just as Middle East tensions embed a structural risk premium in energy and freight rather than an immediate supply shock. At the same time, inflation running with a 4-handle and stronger growth data are pushing the policy debate back toward higher for longer, with markets weighing a binary outcome between an extended pause and a renewed hiking phase. For portfolio discussions, the key questions are how much AI concentration risk to tolerate, how resilient exposures are to an energy or freight shock, and how sensitive balance sheets are to a world where policy rates stay elevated and curve dynamics remain unstable. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.